If you have money in a savings account at JPMorgan Chase right now, the bank is paying you approximately 0.01% annual interest, which means if you deposit $10,000 and leave it there for a year, you'll earn about $1. But during that same year, JPMorgan will use your deposit to make loans at 5 to 7% interest, invest in securities earning 3 to 4%, and generate trading profits from the spread between what they pay you and what they earn. And in 2023 alone, JPMorgan made $13 billion in net interest income, which is the difference between what they earn on your money and what they pay you for it. And this isn't accidental or unfortunate. This is the business model, a legally sanctioned wealth transfer from depositors to shareholders that happens continuously, automatically, and almost invisibly. And if you think banks are providing you a service by keeping your money safe, you need to understand that you're not the customer, you're the product. Your deposits are the raw material the bank converts into profit. This is the story of how JPMorgan Chase, the largest bank in America with over $3 trillion in assets, has engineered a system where they pay almost nothing for deposits while earning massive returns. But more importantly, this is about understanding how banking actually works versus how most people think it works. Because the mythology of banking, the story, we're told about how banks intermediate between savers and borrowers, is technically true but fundamentally misleading, and understanding the real mechanics reveals that modern banking is less about service provision and more about rent extraction, taking a cut from every economic transaction, not because they create value, but because they control the infrastructure money flows through. And this extraction happens whether the economy grows or shrinks, whether you make money or lose it. The bank always gets its spread. The mechanics of how this works are surprisingly simple once you understand them. When you deposit money at JPMorgan, that money doesn't sit in a vault waiting for you to withdraw it. The bank immediately puts it to work. They're required by regulation to keep only about 10% in reserve, meaning if you deposit $1,000, they can lend out 900 of it, and they do. They lend it to credit card holders at 18 to 24% interest, to mortgage borrowers at 6 to 7%, to auto loan customers at 4 to 8%, to businesses at variable rates. And all of this lending generates interest income that flows to the bank, while you, the depositor who provided the capital that made the lending possible, earn essentially nothing. Let's calculate exactly what this means in practice using JPMorgan's actual numbers. From their 2023 financial statements, they hold approximately $2.4 trillion in deposits, and they pay an average interest rate on those deposits of around 0.5%, which generates about $12 billion in annual interest expense that they pay to depositors. But they take those deposits and invest them in loans and securities that earn an average return of approximately 3.5%, generating about $84 billion in interest income, and the difference between what they earn and what they pay is $72 billion. That's the net interest income, and after accounting for operating costs and loan losses, they keep about $13 billion of that as profit. $13 billion extracted from the spread between what your money earns for them and what they pay you for the privilege of using it. Now you might argue that banks provide valuable services. They keep your money safe. They provide ATM access. They process transactions. They offer convenience, and all of that is true. But here's what's interesting. The actual cost of providing those services is far less than the profit they extract through the interest rate spread. JPMorgan spends about $40 billion per year on total operating expenses, including technology, employees, branches, everything. And they serve roughly 60 million customers, which means the cost per customer is approximately $667 per year. But the average checking account customer keeps around $5,000 on deposit, and on $5,000 at a 3% spread, JPMorgan makes $150 per year, which doesn't seem like enough to cover the service costs until you realize that many customers keep far more than $5,000 on deposit. The median is skewed upward by wealthy customers with 6- and 7-figure balances, and those customers are subsidizing the entire operation while earning almost nothing on their money. But it gets more interesting when you understand what banks do with deposits beyond traditional lending. JPMorgan operates a massive trading operation. They trade currencies, interest rate derivatives, credit derivatives, commodities, and they use deposits as collateral and capital to support this trading. And the trading desk made over $12 billion in revenue in 2023. And while the bank will tell you this trading is done with shareholder equity, not deposits, the reality is that deposits allow them to maintain the leverage ratios and collateral positions necessary to trade at the scale they do. Your deposit sitting in a checking account earning nothing is simultaneously supporting a trading operation that generates billions in profit for shareholders. What would you do if your bank sent you a letter that said, "We're going to take your money, invest it, earn 3 to 4% returns, keep almost all the profit, and pay you essentially nothing"? Would you accept that deal? Would you think it was fair? Or would you pull your money out immediately? And yet this is exactly what happens. The only difference is nobody sends a letter explaining it in plain terms. Instead, it's buried in fine print, masked by the mythology of banking as service provision, normalized by the fact that every bank does it, and enabled by the oligopoly structure of banking, where the 5 largest banks control nearly half of all deposits, giving you limited alternatives. The history of how we got here reveals something important about financial evolution. For most of American history, banks actually paid meaningful interest on deposits. In the 1980s, savings accounts commonly paid 5 to 8%. In the 1990s, they paid 3 to 5%. And this wasn't generosity, it was competition. Banks competed for deposits by offering higher rates, and depositors shopped around, moved money to better deals. And this competitive pressure kept rates reasonable. But 2 things changed. First, the repeal of Glass-Steagall in 1999 allowed commercial banks to merge with investment banks, creating massive institutions that could fund lending through multiple channels, not just deposits, reducing their dependence on offering competitive rates. And second, the Federal Reserve dropped interest rates to near zero after 2008 and kept them there for over a decade. And this zero-rate environment allowed banks to pay almost nothing on deposits while still earning positive spreads on lending. The Federal Reserve's role in this is crucial because the Fed sets the rates banks pay each other for overnight lending, and those rates influence but don't determine what banks pay depositors. So when the Fed keeps rates at zero, banks drop deposit rates to near zero. But when the Fed raises rates to fight inflation, banks don't immediately raise deposit rates proportionally. They widen the spread, they pay depositors a little more, but not nearly as much as they're earning. On the other side, and this is what happened in 2022 and 2023, the Fed raised rates from near zero to over 5%, and JPMorgan started earning much higher returns on loans and securities, but deposit rates only went from 0.01% to maybe 0.5 to 1%. The spread exploded, and so did bank profits. If you're starting to feel like the financial system is designed to extract from you rather than serve you, that's because it is. And understanding this changes how you think about where to keep money. And if you want to learn how to navigate a system built to transfer wealth from ordinary people to financial institutions, you need to subscribe to this channel, because we document these mechanisms in detail, show you how they work, and explain what you can actually do about it. So hit that subscribe button and turn on notifications, because what comes next in this video is going to show you the hidden ways JPMorgan makes even more from your deposits than just the interest spread. The second way JPMorgan extracts value from your deposits is through fees, overdraft fees, maintenance fees, wire fees, ATM fees, insufficient funds fees, and these add up to billions. In 2023, JPMorgan collected approximately $8 billion in consumer banking fees, and while they've reduced some fees in response to public pressure and competition from fintech companies, they've also introduced new fees and raised others. The average customer pays approximately $200 per year in various banking fees, and for customers who occasionally overdraft, that number is much higher. The median overdraft fee is $35, and customers who overdraft frequently can pay thousands per year. Now, the bank will argue that fees are charged for services rendered, that overdraft protection is a service that has costs, that maintaining branches and ATMs requires revenue. But here's what's interesting about the economics. The marginal cost of processing a digital transaction is essentially zero. It costs JPMorgan nothing to move money from your checking to savings or to another person electronically. The infrastructure is already built. The transaction is automated. There's no human labor involved, yet they charge for it. And the reason they can charge is because they control access. They own the platform your money sits on, and if you want to move it, you pay the toll. The third extraction. mechanism is less obvious but potentially more significant, which is the value of your data. JPMorgan knows everything about your financial life. They know where you shop, what you buy, when you're paid, whether you're financially stable or struggling. They know your income, your debts, your assets. And this data is incredibly valuable. They use it internally to target you with credit card offers and loan products, but they also aggregate and sell anonymized versions to third parties, including other financial institutions, retailers, and data brokers. And the value of this data is hard to quantify, but almost certainly runs into billions of dollars annually across the banking sector. What's particularly insidious about the data extraction is that you have no choice in the matter. If you want to participate in the modern economy, you need a bank account. You can't get paid by most employers without one. You can't rent an apartment. You can't establish credit, so you're forced to give up your financial privacy to an institution that will monetize that information without compensating you or even clearly informing you about how they're using it. And this represents a fourth dimension of extraction beyond interest spreads, beyond fees, beyond data, which is the forced nature of the relationship. The comparison to taxation is deliberate and accurate. A tax is a compulsory payment to an authority. You don't choose to pay it, you're required to, and the authority uses the revenue to fund its operations, and banking works similarly. You're effectively required to have a bank account to function in modern society. The bank takes a spread on your deposits that you never agreed to explicitly, uses that money to generate profits, and you have no real recourse because all banks operate the same way. It's a private tax system operated by financial institutions with government sanction. The government's role in enabling this is important to understand. Banking is one of the most heavily regulated industries. Banks can't open branches or merge or change products without regulatory approval, and this creates a barrier to entry that protects existing banks from competition. A true free market in banking would allow new entrants to compete on rates and services, driving spreads down and quality up. But regulations, while necessary for stability and consumer protection, also serve to protect incumbent banks from competition. And those banks have enormous influence over the regulatory process through lobbying and the revolving door between bank executives and regulatory positions. Let me show you how the numbers work from an individual perspective. If you keep $20,000 in a JPMorgan checking account earning 0.01%, you make $2 per year, but JPMorgan can lend that money at an average 5%, earning $1,000. They pay operating costs of maybe $100 to serve your account, and they keep $900 as profit. That's a 900% markup on the service they're providing. And you agreed to this by signing account agreements you probably didn't read carefully. And even if you did read them, you had no ability to negotiate different terms. You take what the bank offers or you don't bank there. And since all major banks offer essentially the same terms, your choice is illusory. The question becomes, what can you do about this? And the answer is more than you think, but less than you'd hope. You can move some money to high-yield savings accounts at online banks that pay closer to market rates, currently around 4 to 5%. You can keep only the minimum necessary in checking accounts at major banks. You can avoid overdraft and maintenance fees by understanding how your account works. You can use credit unions, which are non-profit, and return more value to members. But you can't completely opt out. You can't avoid being part of a system designed to extract value from your deposits. You can only minimize the extraction. The deeper question is why we accept this system, why we allow private institutions to create money through lending, to charge us for access to our own money, to extract billions in profits from deposits that earn nothing. And the answer is partly that most people don't understand how it works. They believe banks are warehouses that store money rather than profit machines that leverage deposits. And partly it's because banking is so embedded in the economy that imagining an alternative seems impossible. But alternatives do exist. Public banking where deposits are used for public benefit rather than private profit. Narrow banking where deposits are only invested in safe government securities. Digital currencies that eliminate intermediaries entirely. None of these is perfect, but all would reduce the extraction that currently happens. The comparison between what JPMorgan earns on your deposits and what they pay you reveals something profound about power in the modern economy, which is that controlling infrastructure is more valuable than producing goods or services. JPMorgan doesn't make anything. They don't manufacture products or create innovations. What they control is the payment infrastructure that money flows through, and that control allows them to extract value from every transaction, every deposit, every loan. And this extraction is embedded so deeply in the economy that it's invisible to most people, until someone points it out. Think about the scale of this wealth transfer. $13 billion in profit from the deposit spread at one bank in 1 year. Multiply that across all banks and all years, and you're looking at trillions of dollars transferred from depositors to bank shareholders over decades, and the depositors don't even realize it's happening. Because the transaction is framed as a service, you're supposed to be grateful the bank keeps your money safe. Never mind that they're earning 3 to 4% on your money while paying you 0.01%. Never mind that the difference goes to shareholders and executives. Never mind that you have no real alternative. The moral argument for this system is that banks take risk. They might not get repaid on loans. They might suffer losses in trading. They need to earn returns that compensate for that risk. And there's truth to this. Banking does involve risk, but the question is whether the spread between deposit rates and lending rates is proportional to that risk, and the evidence suggests it's not. Banks have been consistently profitable for decades. JPMorgan hasn't had a losing year since the financial crisis. They've paid out billions in dividends and buybacks. Their executives earn tens of millions, and this level of profitability suggests the spread is far larger than necessary to compensate for risk. It's pure extraction enabled by market power and regulatory protection. You're probably wondering if this will ever change, if depositors will ever earn fair returns, if the spread will ever narrow, and the answer is probably not without either dramatic technological disruption or political intervention. Technological disruption is already happening through fintech companies that offer better rates and lower fees, through cryptocurrencies that eliminate banks entirely, through peer-to-peer lending that connects borrowers and lenders directly, and these technologies are slowly eroding bank power. But slowly is the key word. Banks have enormous resources to acquire competitors, lobby for favorable regulations, and protect their franchise. Political intervention is possible, but unlikely given bank influence over the political process. Every major financial reform in American history has come after a crisis. Glass-Steagall after the Depression, Dodd-Frank after 2008, and even those reforms get watered down over time through industry lobbying. So, expecting meaningful change without another crisis is probably unrealistic. And even after a crisis, the changes tend to be insufficient. Dodd-Frank didn't break up the big banks. It made them slightly more regulated but also more entrenched, and that pattern will probably repeat. What this means for you as an individual is that you need to understand how the system works and make decisions accordingly. Keep minimal balances in checking accounts at major banks. Use high-yield savings for emergency funds. Consider credit unions for better rates. Be aware of fees and avoid them. Understand that your bank is not your friend, but a profit-seeking entity that will extract value wherever possible. And most importantly, stop thinking of banking as a service and start thinking of it as a tax you pay to participate in the economy, because that's functionally what it is. The $13 billion JPMorgan made from the deposit spread in 2023 came from millions of depositors earning nothing on their money, and most of those depositors don't even know it happened. They don't read financial statements or understand net interest income. They just see their balance staying roughly the same and assume everything is fine. Meanwhile, the bank is generating massive returns on their money and paying them essentially nothing. And this has been happening for decades and will continue happening until enough people understand the mechanism and demand change. If this video has changed how you see your bank account, if you're looking at that 0.01% interest rate differently, if you're starting to realize that the financial system is designed to extract from you rather than serve you, then you need to watch our next video where we're going to show you exactly what banks do with the $13 trillion in deposits they control, how they use your money to trade derivatives and make speculative bets, and why the next banking crisis will come from exactly this behavior. Subscribe now and turn on notifications, because understanding how banks really work is the first step toward protecting yourself from being exploited by them. And hit that like button if this explanation made you angry, because anger at injustice is the beginning of demanding something better.